The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and thank you for being with us today. Those of you in the Northern Hemisphere. And Hank, morning to you, my friend. And Dean, right on the ball here. Hi from Canada, sound is fine. And also Joel from Vero Beach. Good, great. And Sim up in Kuala Lumpur. Very interesting fellow, Sim, one of the very interesting people I get to meet by doing tutorials. Sim is starting to get towards the end of doing his Daniel Code tutorial. But he has him and his wife have a PEC Sim, the lovely PEC Sim. Hello, PEC Sim. They have a business as teaching people scuba diving. But his day job is he plays in the National Orchestra. So what a talented lot of people we have as clients. Great to have you all here, folks. Let's see what else is happening right here. And I should say good morning to those down under, and good afternoon to those of you across the ditch. Albert's with us. Yes, he's a tutorial guy, and Chase is with us. Who's largely responsible for the smoke-free webinars now. Great. Dean just had a very, very big trade in silver. George is with us. Graham over in New Zealand. Greg, Hank down the Hunter Valley. Jeff, he's a tutorial guy. Haven't heard from you for a while, Jeff. Hope your trading's going well. Joel's over in Vero Beach. Mark, he's an early tutorial, video tutorial guy, which is what we've been doing for the last couple of years. Going to be a very good trader, but he's a bit busy with his other jobs at the moment. Murph, of course, a great stalwart, always with us, as is Milton. Norbert up in Canada. Peter, the Mac, the day trading guru. Scott, of course, doing a tutorial with us. Tom over in Florida, the wealth manager. Great to hear from you, Tom. And I gather your partner's considerably better now. I hope he's recovered. He had a very, very bad bout of the rotten COVID, didn't he? And his wife as well. Terrible. Trevor, he's a great stalwart of ours. Lovely to have you with us, Trevor. And Vincent in New York, who's getting ready to do his Daniel Code tutorial next week. So it's good to have all of you with us, and more coming in all the time. Anyway, we're at the appointed time, so let us move on and talk about the joy and benefit of markets. Markets are rational, orderly, and sometimes predictable, as you'll see when we go through today's tutorial. Honestly, the trading has just been so fantastic, hasn't it? Excuse me. I mean, the trading has been absolutely marvelous, and I guess all of you are exhausted from counting your money. If you're not, and you missed the big trades that we've seen in the last week, do get your free trial of the Daniel Code and see how you can be with the trend all the time. Okay, let's move on. The amazing story of gold. This chart comes from one of our webinars. It was called The End of 20, and that happened on July the 1st this year, of course. And I showed you this chart and said that a close above the Daniel Code black line, 1827, a daily close above the black line, turned the probabilities heavily in favor of new all-time highs. And as you can see, of course, that's exactly what we got. And this is a copy of a chart from the charts that have been updated, but the statement at the top, of course, that actually comes from the previous webinar. But look at that trade. I mean, it's huge. This is how it worked out. That's when you got the close. You got the daily close above the black line. You buy the close and hang on like a mad dog and wait for the Daniel Code sell signal. There's some part of $20,000 in that move now. I mean, it's extraordinary, isn't it? If you were trading success, then you got short for a few hours after the inside bar there that you can see, the red bar, and then you got long again into the low of the high when, of course, we got short and had the lovely ride down with it all. But just amazing trading. Or you could do even better than that with our success program. And there's some part of $21,000 in this trade on success. Extraordinary stuff, just amazing volatility. It's wonderful. Okay, see if we can catch up to where we were just now. See if I've gone one too far. I hope I haven't. Yes, I have. I've gone too far. That was where we were up to there, so I'll try and keep this little box down here open so I can not lose my way. So still on success. This has been the recent history of our coffee trade, some part of $10,000 on a $4,500 margin. I told you at the tutorial the webinar, I should say, the previous one, that you should always be aware of what the margin is. The biggest dollar market moves are not necessarily the best because it's all a function of margin. That's the money you absolutely not negotiably have to put up, whether you're a private trader or if you're a corporate, you might be putting up security to the effect of the margin. But either way, you've got to place margin unless you're with who were that hapless crowd that got caught on the oil interactive brokers. There we are. They didn't really do their job as a broker, and I'm talking about when oil had its crash. It got down to about $6 in crude oil, but it was really the story of the ETF, oil, OIL, which had a whole lot of people trading it who obviously didn't know what a futures contract was. And it's an unusual ETF because it had some futures contracts in it. And that means, of course, that you have to get out of the contract before the last day of trading, and they didn't, and they got caught on settlement. And there were literally, it was something like $450 million of long positions that couldn't take delivery because they were traders or investors or mum and dad at home, the whole range of it, but none of them, of course, had the capacity to take delivery of the oil contract, which is you need to be in the business to have those facilities. So interactive brokers obviously got things got out of hand with them, and instead of keeping their clients within the margin of their the margin of their margin, if you like, they finished up that there were a whole lot of people who couldn't pay, and interactive brokers had to pay 88 million, I should say, of those losses. Extraordinary stuff that a big firm like that wasn't aware of its clients' positions, and I guess probably not aware of what was in the ETF either. Anyway, we don't have those problems, so there's little benefit from success. So we want to talk about the lunacy and brilliance of markets. And I want to talk a little bit about correlations and substitution. So some markets, if you've been with us for a while, you'll know all of this stuff, so I won't dwell on it unduly, but some markets are so correlated that a signal in one, a Daniel code signal in one, can be executed in any other, provided the trade is elected. Now, what I mean by that is that all Daniel code signals are conditional signals until they're elected. We don't have the hubris to think that we know what the market's going to do. What, in fact, we do is we create signals based on probabilities. Everything to do with trading is probabilities. We don't have foresight. We don't know what the market's going to do tomorrow. Norbert saying he uses interactive brokers. They hunt me down days before expiration to get out the L contract. Well, I bet they do, but they certainly missed that one. The people who were in that ETF, I guess they assumed the managers of the ETF had it covered, but they didn't. Anyway, that's what happened to them, and we're now talking about correlation. So by being elected, if you look at the trade program on the Daniel Code website, it's called Trade Program, pretty simple. That tells you exactly where the entry for each Daniel Code signal is and where your initial stop should go. We need, if once we believe we have a valid signal, we then need the market to confirm that it's thinking the way I'm thinking. That it does that by electing the signal, going to the number that we put in the trade program every day, and that's what makes a signal elected. At that stage, it goes from being a contingent to an actual signal. But some of these markets are so highly correlated that you can use them to take trades in other markets. So, for example, if you didn't want to trade gold, you could have taken the gold signal in silver. In fact, this was a pretty straightforward one because we had blue line TO3 and blue line sells at the high in both gold and in silver. But sometimes, like today, we'll have a signal only for one of them. It's in gold today. But if you want to, you can execute that signal in silver, so long as it is the trade is elected. And we also take signals from the HUI, which you can't trade in futures. You can trade it in options. And the HUI is actually an index, and it's an index of 25 large gold miners that do not hedge their forward production. And it works as a substitute signal for gold and silver. You can get signals off the HUI that are quite valid to be elected in gold and in silver. So I know that Dean has been hunting gold. He was long all the way up. Last week, the most important position was to be long gold or long silver, or one of them at least. This week, of course, the most important trade's been to take the Daniel Code sell signals and be short. And there's some part of $19,000 in that fast move down in silver. And those of you who've done a tutorial will know how to handle these very, very big dramatic moves to lock in some of that profit. You don't, when we get the drama that we've had in gold and silver, and which I suspect we're going to see a whole lot more of as the year unfolds. Remember that at some stage in these massive moves, you should be going to a trailing stop to protect your profits. Don't make that trailing stop too small, or you'll get stopped out. Intraday moves are over $2,000 in gold at the moment, so you can use 1.5 times average daily range as a trailing stop if you get a big dramatic move. So Tuesday to the TO3 and blue line signal, and talking about brilliant, let me tell you how brilliant this stuff is. I'll just bring up that contract over here, and here we are. So that bar that's got the TO3 and blue line sell signal marked on it, the high of that bar was 2081.8. The blue line was at 2083.2. About 14 or 15 ticks we would allow at this number. It's got so big we would allow 20 ticks to come within our 0.1% variance. Very, very accurate. It's extraordinary stuff, really. But that big bar down Tuesday, that was the biggest bar in gold for 7 years. So you really, really must get those big trades. They're the ones that really put the cherry on top of the ice cream for you. So if you didn't get that trade, you should have been long since the lows, near the lows anyway. The buy signal, actually, the buy signal from that came from July the 1st. July 17th, I'm sorry, I should say, on this particular run, and just went straight up. I mean, that run up, for those of you who were trading, was some part of 21,000 in gold. Quite extraordinary, really. In the success, you got almost all of that, but you got reversed for a few hours on July the 28th, and again on July the 30th, but didn't lose much. And that's the whole point of trading, that we do have losing trades. They're inevitable, but if you have the your average winning trade is multiple 2 or 3 times your average losing trade, which it is in success, you certainly make a whole lot of money. So that was a massive one. If you didn't get it, folks, you weren't long going into the high and short down into yesterday's low, please go and take a free trial of the Daniel Code. See for yourself how you can actually trade these markets so efficiently. It's absolutely wonderful stuff. Okay, but there's more. This is the slide from our last webinar, July the 30th. And this is the actual slide. It says, the last webinar, we identified the low before the low. You'll remember this if you're a regular attendee at my webinars. The low before the low is a really, really important signal that tells you that's where you're going to start your count on time. So we showed you that, and we put the red line on the chart to show you it was a what we call the low before the low, and at the same time, you remember right at the end of the last webinar, we put a time cycle on it, and we had the big bar, which was effectively the high at that stage, right on the Daniel Code 44 cycle, and that's the vibration of gold. If you're not sure how that works, go to the articles tab at the Daniel Code website and read the article. That particular one is called Masterclass 2, Trading Gold. It tells you exactly why and how 44 came to be the vibration, the dominant vibration for gold. Okay, and then that day I showed you the first swing. You remember that? And that was from the last webinar. Now, once I've shown you the first swing, you remember I've spoken to you about this and shown you this technique so often. Once you get a setup that's valid, every single swing thereafter will create a valid time signal. So you can see the first red line on the left-hand side of your chart as you look at it. That's the 44-day cycle that came from the previous webinar. That I showed you that and said there it is. It doesn't mean it's the high, it doesn't mean it's the end of the run, but it's important to know. So if you then move your Daniel Code time tool on to the other end of that cycle, in other words, that's the low. We used first of all the low before the low, now we're using the swing low that set it all up. Look what it did. 44 days into the high. And there it was exactly. August the 6th was the high of this particular exciting move in gold. And the blue lines signals were there. And there you simply, if you watched the last webinar, I guess you knew that there was another 44-day cycle expiring on that day. And that's the closing high of that whole move. Quite extraordinary. So to that, you add the Daniel Code blue lines. 2083.2 is the Daniel Code blue line, been on the chart for weeks and weeks, and there it was, and that was the setup, folks. It was very persuasive. In fact, it was brilliant, wasn't it? If you got the money, it was brilliant. If you didn't get the money, you're probably annoyed with yourself, but you don't have to be annoyed. Go and do your free trial of the Daniel Code website and see how marvelous all this stuff is. I mean, once you learn to trade properly, I promise you, you will absolutely fall in love with trading. Apart from the obvious benefit that this is, in my opinion, the best legal way I know of making large amounts of money, the sheer satisfaction you get from being able to understand markets so well, you'll be like I am. You know, I'm on a high. I'm pretty much always on a high about trading. And I've been doing this stuff for over 20 years. And the Daniel Code website, don't forget, it's been public for 12 years now, going on for 12 years in December. And nobody is more amazed by this stuff than I am, I assure you. I mean, it is just absolutely extraordinary. And look what happened even on, this is some of these charts have got Wednesday as the last bar on them because I have to prepare most of this stuff the night before. But here we are there. Look at what happened today. Those are Daniel Code retracements, 1969.9, and look where that market closed today, 1970.4. 5 ticks variance, which is like nothing. It's less than a hair. 5 ticks variance in the volatility of this market. It is absolutely extraordinary. And of course, just to bring that up to date, we had a TO3 plus buy signal today for gold. And as it's correlated, you could have executed that signal in gold or, if you wished, in silver. Okay, here's the US dollar index and gold. As our regulars know, they are inversely correlated for substantial periods of time. Not always. This correlation of gold and silver comes and goes. It waxes and wanes. But when they are correlated, they're inversely correlated. So as gold goes down, US dollar index will go up. As the US dollar index goes down, gold will go up. So you can see that the sell signal for gold earlier this week was, of course, also a buy signal for the US dollar index. And add that, a few more things. I don't know if the guys, let me see here, Tom from Vale joined us. Tom. Todd from the West Coast has joined us. Good to see you here. They're all coming in. You're all a bit late, folks. A lot of people are here with us today. I should just go back and make sure I greet the Macshays. They've been with us a long, long time. Alan, he's a tutorial guy. So's Albert. And Brad. Sim, of course, I've talked to you about. David with it. Dean's a very, very good trader. He's been aggressively chasing silver. I hope he got the. I know he got the short. He wrote to tell me as well. Ewell, good to have you with us. Ewell, I hope your trading is progressing. If not, let me know, please. George with his gig has arrived from either swanning around on Myrtle Beach, his holiday home, or he might be in North Carolina. Good to have you with this gig and hope you're well and happy. Graham, and greetings, Graham. Over in New Zealand, Greg, Hank down in the Hunter Valley, grandfather of the year, isn't he? He says I'm only a day late. Janet over in Canada. Janet's been with us. She's one of our longest serving Daniel Code members. She's done many tutorials. She's a lovely, lovely lady. Great to have you with us, Janet. Jeff, I've greeted you. I haven't heard from you for a while. Glad to have you there with us. Joel from Vero Beach. John L down in Coffs Harbour. Great to have you with us. You would have enjoyed this current chart, John, because you were at the tutorial when we talked about moon cycles and apogees and perigees. I mean, you can't actually trade apogees and perigees without some other tools that I have, but if you look at apogees and perigees over a period of time, they are a bit more than persuasive, aren't they? And what we're talking about, folks, are moon cycles. These lunar cycles have amongst their other wonderful attributes apogees and perigees, because the moon is circling the Earth on a elliptical orbit. So there are times when the moon is as close to the Earth that it's going to get in that current cycle, and they're called perigees. And the other side is that they're as far away as they're ever going to be on that cycle, and that day it's called marked by an apogee. It's interesting because you've got the change in gravity. Those of you who know about land tides, you've got that change in gravity, and it definitely has an effect on market. It's not specific to the day, but there are sequences that repeat again and again and again, and this is one of them. Then the apogee came for the gold trade just the day after the big reversal high, the key reversal bar at the danger code blue line. So the thing about apogees is that they're plus or minus 1 day because of the timing of them and the way the markets are timed. They're accurate to plus or minus 1 day. So there we are there. What else is happening up to? Justin Keith. Boy, we had a lot of people come in later today. Mark, I've talked about. Matt. Murph, I've talked about. Milton, of course, he's a stalwart. Norbert's up in Canada. Paul's with us. Peter, the day trading guru, is with us. Philip's with us. Rod over in Rob, my good mate over in New Zealand. Good to have you with us, Rob. You're back in lockdown now, mate, eh? Scott's with us. He's doing a tutorial. Sean's with us. Tom, the wealth manager I've greeted, as I have Todd Timmons. Trevor's with us, and I've already said hello to Tom up in Vale, and Vincent in New York. So let's move on. It's interesting, folks, if you are sort of passionate about markets as we are, certainly I am, how these lunar circles, these lunar cycles, hoo-ha, lockdown, says Rob, quite right. How these lunar cycles interact with markets is really quite extraordinary. You can spend a good part of your life looking at those and thinking about it. So moving on at this wonderful bit of trading we've had, this is a chart on 6S on T-Bonds, which is not usually a star performer, but certainly has been recently. And I've put this chart up to show you the losing trade right at the high. That we do have losing trades, and I'm talking about the long trade. We got short and we got back in long on August the 4th, and I've moved off again. Look at this thing on August the 4th, and that's this chart, this bar right up here, that gave us the closing high of that whole move. Now that. By our measurements, that restored the trend to up on the daily charts. But so we were long, but then it put in a slightly higher, a fake high, gave you a chart high but not a closing high, and then reversed to a sell. So we lost money on that trade, but we lost $812 odd on that trade. And since then, as you can see, we're now plus 3,800 odd in the current trade. So I want to show you this so you don't get the opinion that I only show you winning trades. We do have losing trades. That's a part of the business. It's unavoidable. But if the losing trades consistently are a fraction of the winning trades, then you've got a massive winning formula, and that's exactly what I'm trying to show you there. Great trade in T-bonds there. Soybeans as well. This is an interesting trade. It's really found some gas again, hasn't it? If you go right back to the beginning of this chart, it had a series of really huge up bars, lots and lots of enthusiasm about something or other. Then it sort of had a correction and an up and a down and an up and a down, as markets do, and it got us until Tuesday. I should say Tuesday we got a TO3 signal, and it was also a 6S buy signal. And look at this, for a market like soybeans, a $1,100 move in a couple of days is pretty great value, isn't it? So those of you, I know a lot of you who want to trade 6S are more interested in the markets that have smaller margins, but it just shows how rewarding that program is. Okay, so this was the fourth seal on gold, July the 27th. A young Belgian gentleman called Frank DB helps me with the fourth seal. In fact, he does most of it these days. And he came to a tutorial I was running in Taupo, New Zealand, back in 2010 or 2011. And he brought his fiancée with her. Her name was Anne, a very lovely lady. And he said to me, I know nothing about trading. I've never seen a trading chart. I don't know what it looks like. I don't read financial news. I'm a farmer. But I like your articles. He's a strong Christian boy. And Frank, his name is Frank DB. And he said, I want to learn how to trade. So that was actually the first tutorial at which I taught the fourth seal. And Frank took it and became obsessed with it. And that's the, everyone finds a part of the Daniel Code that really relates to them and they're more interested in. And for him, it was the fourth seal. So he made his mission to do that, keep all the charts. We do 6-day, 12-day, and 24-day charts to run the fourth seal, which he does valiantly, and he's really become a very, very savvy trader. And he's done that by doing. He's learnt by doing. And he's a really smart guy. And this is the guy, of course, who's saying he did a forecast for us at the beginning of the year, which is at the Daniel Code website under the Articles tab. And he's saying that the fourth seal, the probabilities are that we get new highs into 2021 before some dramas later on in that year. And then we got the COVID flash crash, as it turned out, in equities, and he was incredibly solid on it. He happy to say it sounds stupid now, when the week that it was right at the bottom of that pretty savage correction, but he stuck to his guns and said, there's the forecast, new highs, all-time highs in the S&P into next year. That's Frank's forecast. So this is what he was writing about gold on July the 27th. And this is what he's written this week. And as you can see, the cycle top ends this Monday. Sell signal on Friday. Odd we see some kind of correction here. Gold needs to let go some steam. So he's absolutely nailed it. And that comes out every Monday. For those of you who are interested in it, a lot of our clients are very interested in the fourth seal, and you should have a look at them on your free trial he covers for us. So we cover crude oil, S&P, and gold. Pretty amazing. And here's the chart. This is the 6-day chart that Frank's working off. Have a look how it's just gone. Gold's gone straight in to its 59 cycle there. Quite really interesting. Now remember that all of these signals in the Daniel Code don't speak to quantum. They speak to the fact that a turn is highly probable, or that a continuation is probable. They do not speak to quantum. The quantum you get from the trade is a function of market volatility and your knowledge and ability how to trade it. So we're back now on this chart, which you've seen many times before. It's gold on the top panel, and US dollar index on the bottom panel. And it's showing you that gold and the US dollar are inversely correlated. So I've put in here the daily chart, daily bars, just to make it clearer. Now, this pattern doesn't last forever. I read an article about it some years ago, but when this inverse relationship is working as it is now, it's very, very strong. And when it fails, it always fails in favor of gold. Gold always continues to rally when this inverse relationship fails. Now, let me make clear that the word always hardly exists in the trading lexicon. By that I mean very, very high probabilities that it has exhibited in the past. So be sure of that. Last week, or 2 weeks ago, fortnight ago, at our last webinar, I showed you this chart and said the US dollar index is trying to rally on that diagonal red line. It had on the way down from its double top, it hit the 94.61 retracement perfectly on the way up. Look where it is now. It's not tracking the 92 retracement, one of the Daniel code red lines. It's stalled above that, and it looks to me more evident that it's trying to rally along that diagonal line. So keep an eye on that, folks. It's pretty good stuff. So some markets are so correlated that a Daniel code signal in one can be executed in any other, provided that the trade is elected. In other words, provided that the market in which you're going to execute goes to the number that's required for the trade to be elected. And if its signal is in a different market, you will know, it's very simple to work out where our buy and sell points are on daily bars. In futures, it's true high and true low, plus or minus 2 ticks. And in Forex, it's true high and true low, plus or minus 5 ticks. So we have to use a bigger buffer in Forex because there's no central exchange for Forex, and some of these markets, the results can be a few ticks off, whereas with futures everything goes through one exchange, so everyone has exactly the same prices. You know with certainty where the true highs and true lows are. Some correlations, US equities and Germany DAX, they're permanently correlated. Russell, Dow, S&P, NASDAQ, and Germany DAX, they're so highly correlated that they all tend to move in the same direction. Now, that correlation, folks, is nothing about quantum. All it tells you about is position. In other words, if you get a reversal in one of those markets, it's highly probable you're going to get a reversal in one of the other markets. At various times, now as an example, that correlation breaks down under pressure. And I can tell you equities are under enormous pressure. The Fed, and no doubt at the behest of the government, is just flooding the markets with liquidity, and that's just pushing the S&P and the other equities up. But that market desperately wants to have a pullback and reset. So there's a conflict, which is why right now all of the equities and Germany DAX are not in complete simpatico. So you've had an inside bar in one and an up bar in one of the others, or vice versa. And that's because they're under pressure. But by and large, the vast majority of the time, all US equities and Germany DAX are highly correlated. So some markets have that inverse correlation that we saw in gold and the US dollar index, and that may be permanent or temporary, but it will show you what it is very clearly. Then we have to look at substitutions. Substitutions occur across a range of markets, particularly grains and oilseeds. So if you think about the oilseed and the grains market, a vast bulk of that, maybe not the highest dollar value of it, but a vast bulk of it actually goes into stock feed. So corn, soybean meal, they're highly correlated. And you can see that because you can substitute. That's how that correlation comes, because you can substitute them. The feed value from one of those can be measured in regard to the feed value of the others. So this is an S&P and T-Bonds chart. This is to show you how these correlations switch. Back in June, you had inverse correlations. You had the S&P going up strongly, and you had T-bonds diving to the bottom. So you had an inverse correlation there. Then when that particular period of time ended, you had both of them working in the same direction. They both rallied. So you had a long period, probably from, we'll have a look at July, all the way through till a month or so ago, where these two markets were correlated. They were both going in the same direction. And now they've switched back to the inverse correlation. You can see T-bonds going down while the S&P continues its ever upward flight. So the obvious correlations, the equities, they are essentially, they're a permanent correlation. The relationship between some of these other markets, have a look at them for yourself. This is a really interesting one because there are all sorts of theories about correlation or otherwise on the S&P and down. Basically, the thinking is that it's always in an inverse correlation. S&P up, bonds down, bonds up, S&P down. But you can see that's not true. It does happen for long periods of time, and it can be quite extreme, as we saw at the end of June this year. But it doesn't have to stay that way forever, and you can see for that whole period through to very early August, this is a daily chart, the correlation was contemporary. In other words, they were both going up. Interesting, isn't it? So be aware of those things, folks. It's just another little edge that can help you when you're thinking about your trading. So here's corn and soybeans in the this offset chart. The top panel is corn, the bottom panel is soybeans, and you can see how they're correlated, and that's primarily due to substitution. You can substitute one of these for the other in its biggest volume used, which is stock feed. Very important. Get your head around it. Sometimes these correlations are so strong that a signal in one, you should be aware that there might be a signal for the other as well. So you can see here soybeans has really taken off in the last 2 days. Have a look. Corn has too. Very tight correlation and potential for great trading if you can get your head around all of that. We haven't talked much about Forex lately, and I do wish to rectify that. We'll make sure we get plenty of interesting things about Forex, because the trading in Forex lately has been really, really good. And this is just showing you a market that is generally correlated, the euro dollar and the New Zealand dollar against the US dollar. Why would it be correlated? Because you've got the US dollar on both sides. So the effect of the US dollar in these markets is very, very similar. And again, you may have reason that you want to take a Daniel Code trading signal in one of the correlated markets. And so long as it's elected, that's valid. So, talking about lunacy, here we are. I wanted to highlight the top of the .com rally back in 2000. That I figured that most of you would probably not even remember that. But in big trends, markets always overshoot. And this is the S&P in its boom into 2007. Big bull market, and then it's the crash into March 2009. I've talked to you about this a number of times. You can see that this market turn put its low in right at the Daniel Code number of 666, the number of the beast. If you're interested in how that transpired, go to the Daniel Code website, have a look at the articles tab, and read the article that's called The Number of the Beast. It was an extraordinary time. I had some guys out here from Bethel Church in California, in Redding, California, and we had some extraordinary things happening. It was quite interesting, very interesting, in fact. Have a look at that article when you get the time. But you can see I've marked two sections of this chart as lunacy, because markets always overshoot. The highs come, they go too far. The lows, they go too far. But you can see the upper of those two blue lines is actually not on the high of October 2007. It's at this big rally around about April, February, March, April 2008. And I put it there because at that stage, it was very, very clear what was happening. Those of you who haven't seen The Big Short, make sure you see it. But it was very clear to most of the traders, knowledgeable people, that this the packaging of loans, property loans, was been ninja loans, and with all sorts of disasters happening, and that was well known to the trading public, but obviously not well enough known, because at that stage that was the most ridiculous rally that I can remember, and I've been trading for a very, very long time. So there was lunacy at those highs that are circled, and was certainly lunacy at the lows. In fact, there was despair at the lows. There were people getting into an awful lot of trouble by that stage. But we happened to be running a tutorial that weekend. Amazing how often these tutorials have coincided with big market moves. And we had blue line buy signals there right at the number that's on the chart, the number of the beast. There it is. So, but even though that was lunacy, look at the solution. The solution was brilliant. What we had was I should preface this by telling you that this chart has moved one period since Trade Navigator moved over to their new data provider. This is a 6-day. Each of these bars is 6 days. So depending on which of those 6 days is the ending date, because it rolls all the time. It's not a standard week or a standard month. It's moved one period, but actually this whole thing came from the high before that, where we've actually shown this counter starting, and we got a 59-day cycle into the high in October 2007. In fact, that cycle came on the day, the 6-day bar before that. It was the closing high of that whole long rally from the recovery after the dot-com crash. And we had a 59 cycle there, and what we do is, when we have a cycle that's valid, we look for it to repeat, and this cycle repeated 59 days ago, 59 lots of 6 days, 59 bars on the 6-day chart, I should say, right into that low, absolutely specific. And that's what I was, trading time was, I was just starting to think about it and get a grip on it and use it a little bit. And there we had the 59 cycle repeated. It was pretty much plus or minus 1 day into that low in March 2009. So the market gives you brilliant solutions to some of these things. I've seen people, I've heard people, certainly, I've read that there were people who were saying that this current rally in gold was lunacy. It's ridiculous. I mean, gold bugs, God bless them, we have plenty of them as members and we love them. But they believe that essentially all fiat currencies, what we have is a fiat currency. It's not backed by any tangible asset. Thinking about it, the previous iterations of currencies were generally backed by precious metals, particularly silver and gold. What we have now is we have what's called a fiat currency all over the Western world. That's backed by the good faith of the issuing currency. In other words, US dollars are worth what they're worth because they're backed by the full faith and of the US government. And gold bugs generally think that's not going to last. It can't last historically, and they may be right. But the problem is, I think all of them will die of old age before they see anything in their lifetimes other than fiat currency. But the theory is that if you revert to the gold standard, which we had before Nixon, you will have gold as the reserve currency. So you can only issue enough credit for the gold that you have stored in your vaults. If you take that view, the value of gold today would be tens of thousands of dollars. But folks, it's a great theory, but it's not going to happen. But gold remains an absolutely marvelous trading tool. It's a great trading market, as you've seen. So there was a solution to that, a bit of lunacy. and you've seen a few solutions as we've gone along with that. And this was what I talked to you about a bit earlier. This chart happens to be crude oil, and on the back of the disaster in the oil OIL ETF, it went down. The oil ETF went down to the futures component. It went down about minus 36 or minus $39, and I mean that's absolute lunacy. The concept that on any day at any time, someone is going to deliver oil to you and pay you, give it to you for less than nothing. They're going to pay you $36 or $39 a barrel to take it. I mean, that's just true lunacy. That's one of the weird things that markets can do, and that was caused, in fact, by the fact that there were so many longs in the WTI futures contract because of their positioning in the oil ETF. And the market had them over a barrel, and when it does, it overcorrects. It went too far. It drove this thing down to its knees, and was great fun. We were short crude oil at the time. Was wonderful. We got long at the right time as well. So there you are. Okay, keep an eye on this May structure in the S&P. You can see that these. I put that usual red line below them to show you that there's a valid low before the low. Now, this actually hasn't given us anything so far, but it is a valid structure. Normally, we would expect to see it vibrating off the first down bar, the first leg of the lows, and then at every swing thereafter. This hasn't given us any significant market moves yet. It's caused a few outside bars, and that's all. In other words, the bull market in the S&P is pushing through all these levels of resistance. Remember that these levels are simply a vibration. You will get a vibration if the time period is valid, if the signal is valid. You could get an outside day, you can get an inside day, you can get no reaction at all. But you should be aware of the times when these cycles are hitting, as you've seen in gold, which we showed you two webinars ago, and again a bit earlier today. You should just be aware of these things. They're meaningful. And we've now got a 70 cycle right on the S&P. As I say, don't put too much weight on this. This particular valid cycle hasn't given us much yet, and we would have expected it would have given us something before now. But not only is today a 70 cycle, it's also a 59 cycle as this blue bar, the originating bar, moves through. So just keep an eye on it. To say that the S&P is overbought is the understatement of the year, but it desperately needs to have, it wants to have a big, dramatic pullback and correct itself, and then probably start again. But be aware this S&P may look calm. It's had an extraordinary run of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days up, 9 days up before it even got that little outside bar, which lasted for exactly 1 day. So that's an unusual, very unusual pattern to see, but it's got plenty of power behind it. But it desperately wants to correct, and if it's going to correct, it will correct from one of the Daniel Code time cycles. Okay, so folks, if you'd like to learn how to do all this stuff that I do, create your daily buy and sell signals, do your forecasting analysis from the 6-day chart, the 12-day chart, be aware of moon cycles and how they affect the various markets, and the Daniel Code time cycles, I'd be only too happy to teach you. So do, if you want to be a super trader, I tell you, it makes your life a lot better, and join the elite. Email me, jneedham@thedanielcode.com, jneedham@thedanielcode.com, and I will send you some documents that set out the sort of things you're going to learn at a Daniel Code tutorial, and how the video tutorials, which we're using at the moment, how they work. And then if you are interested in that, you send me your phone number. I'll be happy to call you and we'll have a chat. So remember, the business of trading futures and forex is not to be right. The business of trading is making money. That's what your business is. And we measure how successful we are by how much money we make. And as I said earlier today, this is, to my knowledge, the best legal way I know of making lots of money. And it's great fun as well, folks, particularly when you know what you're doing and you get the reward. So if you haven't already, you're most welcome to have a free trial. Go to the Daniel Code website, www.thedanielcode.com. Click on the free trial link. Some of you, if you've registered with us before, you may not be able to re-register with that particular email. If that happens to you, contact Terry, support@thedanielcode.com. He will fix that for you in a jiffy. And there's much to learn about it. But feel free, take a free trial. You can see the daily success signals. You can see the TO3 signals, the TO3 plus signals, the blue line signals, the success signals, and of course the fourth seal forecasting commentary. All wonderful stuff. So do take advantage of that, and I hope you enjoy it. David is feeling better, I hope. Tom, yes, he sent me a little email. Good. Thank you for being with us today, folks. That's us for the day. And it's Friday down under. It's Friday, 11:26 a.m. My orders are on for tonight, so I'm finished for the week, folks. And let's hope the last day of the week goes on the way the earlier ones have been. It has been terrific trading. Magical trading, isn't it? When you see how it comes together, you've got to say to yourself, how long has this been going on? And I can tell you it's been going on forever. The problem is that we don't speak the language of the market. Until we got the Daniel Code, we weren't really able to speak that language, but now we do. Not all the time, but the vast majority of the time. So that's us for now, folks. Thank you for being with us. If there's any particular topic you'd like me to cover at the next tutorial, please send me an email. Let me know what you're interested in particular. And if it's a market that I cover, I'll be happy to go into some depth with it at our next session. So that's us for now, folks. Bye-bye for now. Enjoy your weekend. Be safe. Be happy. Count all the money you should have made this week, and if you haven't made it, get on and join the Daniel Code. All the best. Hank, to you, my friend, down the hunter, take care. Bye-bye for now.